This is Nightly Business Report with Bill Griffith and Sue Herrera.
Getting to work, the pace of hiring slowed last month, and job gains in June and July were revised lower. But a closer look shows there's a lot going right for the American worker.
Finding opportunity. Our market monitor has a list of names that she says could do well in this market.
Bright idea. Meet the entrepreneurs who are on a mission to make your home renovation project easier and cheaper. Those stories and more tonight on Nightly Business Report for Friday, September 6th.
And we do bid you a good evening, everybody, and welcome. That strong jobs market has been a driving force behind our economy for several years now. More Americans working means more Americans are spending. But this year, the labor market growth has been gradually slowing, and we got more evidence of that this morning. The economy did not create as many jobs as expected last month. Now, while that may seem disappointing, remember that the unemployment rate still remains near a 50-year low and wages are still rising. What this report does is complicate economic forecasts and Federal Reserve policy decisions. Here's Steve Leisman.
The U.S. job market continued its gradual weakening trend with just 130,000 jobs created in August, and a lot of them were census workers hired by the government. Job growth has slowed from an average monthly rate of 220,000 created last year to an average of 158,000 this year.
This is an okay report, but I do think it shows the labor market softening here, and this economy is definitely shifting down a gear to 2% growth rather than 3% growth, which is what we saw in 2018.
But there was some good news in the report. The unemployment rate remained unchanged at an historically low 3.7%, and average hourly wages were up strongly for the third straight month. There was job strength in construction, leisure and hospitality, and temporary help, but retail and manufacturing job growth were both weak. Fed Chairman Jerome Powell, speaking in Switzerland, was upbeat on jobs in the U.S. economy, but also warned about risks.
The most likely outlook for our economy remains a favorable one. With moderate growth, a strong labor market, and inflation moving back up close to our 2% goal. All that said, there are significant risks, and we've been monitoring those, including, as you mentioned, slowing global growth, uncertainty around trade policy, and also persistently low inflation.
The Fed will announce a new rate decision on September 18th, and markets expect it to cut interest rates by a quarter point. What's unclear is how much comes after that. If the risk factors that Powell is worried about end up dragging down the economy, the job market could weaken further, and that could bring about more interest rate cuts from the Fed. For Nightly Business Report, I'm Steve Leisman.
So let's turn now to Beth Ann Bovino for more on today's jobs report and what it could mean for the Fed and the economy. She is the chief U.S. economist at Standard & Poor's Global Ratings. Nice to have you back with us.
Great to be here.
Give me your take on the jobs report. It was a little softer than what the street wanted, but wages were good.
Well, there's a couple of things to factor in. One, it was a little bit softer, but August is a very tricky month for a couple of reasons. One, all those kids that have those summer jobs, well, they leave and they go back and they go to school. So you start to see jobs go away just for that very reason. Second thing is a lot of those forms weren't filled out. A lot of business owners were also on vacation, so they didn't get around to filling out that form to send to the Bureau of Labor Statistics. What we'll see is probably in September those forms will be sent a little late, and we'll probably see those numbers change, and most likely to the upside.
I mean, we have to keep pointing out, this is still a very strong labor market, still a very tight labor market at this point. Is this slowing, though, enough to convince the Fed to want to cut rates this month?
We look at this report as sure the headline numbers, those scary headline numbers. We finally don't see that 200,000 job gains that we got used to are a little scary, but we see the underpinnings of this report is rather good. You talked about wages. We talked about something that wasn't mentioned is the work week now has gone back up to higher levels. That's positive. That means businesses don't need to basically aren't putting people on furlough and will probably keep people on their books. That means that in our mind that the Fed could probably wait, given that the jobs market is relatively strong. We don't think they will, though, largely because of pressure from what's happening with the tax, with the trade war and other reasons. The Fed will likely move most likely in September.
Does this report kind of take away those fears of recession that we were talking about not just 2 weeks ago? I mean, do you see a recession on the horizon?
We see unfortunately, we do see recession. The risk has increased. Now, it's not at that point where all batten down the hatches, but we do see the risk increasing. We have raised the risk of recession going out 12 months to close to 35%. To put it in perspective, a year ago it was 10 to 15, so it has increased pretty sharply. However, that said, things can change, and the Fed, indeed, in terms of them moving on, basically adding more liquidity into the markets, lowering rates, making it more attractive to borrow and to buy, and the domestic side of the equation is holding up relatively well. That could give us a little bit more cushion as we kind of go through this uncharted territory.
All right, Beth Ann Bovino with Standard & Poor's. Thank you so much.
Thank you.
To the market now, the major averages finished today mixed. Despite the potential for another rate cut this month, investors are still cautious about the slowing economic growth worldwide and those trade war uncertainties. The Dow today added 69 points. We're at 26,797. NASDAQ fell, though. S&P was up just 2. And for the week, all the major averages were higher for the second straight week.
State attorneys general are launching separate antitrust investigations into Facebook and Google's parent, Alphabet. The Facebook investigation is being led by the New York Attorney General, who pointed to issues related to the handling of user data and the price of advertising. Facebook said, quote, "People have multiple choices for every one of the services we provide. We understand that if we stop innovating, people can easily leave our platform. This underscores the competition that we face," end quote. Next week, as many as 30 states are reportedly planning to launch an unrelated antitrust investigation into Google. A formal announcement is expected on Monday in front of the Supreme Court.
Elsewhere, the Department of Justice has launched an antitrust probe into 4 automakers. Officials want to see if Ford, Honda, BMW, and Volkswagen violated federal law by agreeing to tailpipe emission standards that are beyond those proposed by the White House. As we've been reporting, the deal in question was between the automakers and the state of California.
Ahead of a landmark opioid trial that is set to begin next month, the drug maker Mallinckrodt reached a $30 million tentative deal to resolve cases in Ohio. And there are new reports tonight that Purdue Pharma is in talks with the Justice Department to resolve criminal and civil cases against that company. Meg Terrell takes a look at the companies at the center of the crisis.
The opioid crisis has caused about 400,000 deaths in the last 2 decades in the United States. Now it's taking a corporate toll as well, in the form of a series of bankruptcies or potential bankruptcies for makers of opioid painkillers. They face thousands of lawsuits from cities, counties, states, and others seeking to hold them accountable for the epidemic. First, it was Insys Therapeutics, the maker of Subsys, a fentanyl-based pain drug. Insys filed for bankruptcy in June. It was just days after the company settled an investigation from the Department of Justice into its marketing for $225 million. Next, reports that Purdue Pharma was considering bankruptcy. The maker of OxyContin is at the center of lawsuits across the country. It's reportedly planning to file for bankruptcy before the end of this month if it can't reach a settlement first. Then this week, a report that Mallinckrodt had hired restructuring advisors to help consider options to manage its potential liabilities in the opioid cases, including, according to the report, possible bankruptcy filing. Mallinckrodt's CEO took issue with the report, calling it speculation at a Wall Street conference this week.
Obviously, us and a number of other companies are embroiled in probably one of the biggest sets of uncertainties that any of us have seen. And I think people are confusing the uncertainty with some of the actions that we're taking, leading to some of this speculation.
But Mallinckrodt's stock sank to historic lows.
Are we starting to see kind of a domino effect here where one has already fallen and now maybe the others will eventually fall as well? And I think to a certain extent, certainly when you look at the stock price movement of Mallinckrodt over the last week, as it was trading down last week and earlier this week, I think there were concerns that Mallinckrodt could be the next domino to fall. And I think, for our part, what we've said is it's possible. It's not 100% certain.
Wall Street is watching other companies involved in opioid litigation as well, Teva and Endo Pharmaceuticals in particular. Their stocks also declined on the Mallinckrodt news. Now, it's not just that the companies face potential liabilities from opioid lawsuits. They also carry billions of dollars in debt, and their business selling generic drugs has been under pressure for years.
If we just had kind of the opioid litigation piece, that may be manageable. When you combine the leverage with the various litigation and the fact that this litigation is sort of synergistic in a bad way, it's combining to put them all in a really bad spot.
Settlements or fines in the thousands of cases the companies face could amount to billions, analysts say. Purdue has reportedly offered a settlement it values at more than $10 billion, though plaintiffs don't think it's enough. The costs of the opioid epidemic, however, are undeniable. The CDC estimates the total economic burden of prescription opioid misuse at almost $80 billion a year. For Nightly Business Report, I'm Meg Terrell.
Still ahead, paging more doctors.
I'm Kate Rogers in Mesa, Arizona. This state is just one of many that's facing a physician shortage. That problem is growing in America. We're going to tell you why and what's being done to solve the issue tonight on Nightly Business Report.
In the news tonight, Hurricane Dorian. The storm made landfall in the U.S., hitting North Carolina's Cape Hatteras on the Outer Banks and trapping potentially hundreds of people on Ocracoke Island. That island sustained significant flooding and powerful winds, even though the Category 1 storm was much weaker than when it slammed into the Bahamas.
So with the jobless rate near a 50-year low, the labor market remains very tight, making it harder for some companies to find workers and now for some hospitals to find doctors. As you saw, Kate Rogers is in Mesa, Arizona tonight.
Christopher Liu was drawn to medicine at a young age as a Mormon missionary.
I was here in the U.S. and was seeing a lot of elderly members of our congregations, and so a lot of them had multiple medical problems and would talk to us about them.
He was a chemistry major, but decided to use his science background to help people, changing paths to attend medical school.
What do you have for me?
Today, 29-year-old Liu is training to fill an important and growing physician shortage in America, which could be as many as 122,000 doctors short by 2032 in both primary and specialty care, according to the Association of American Medical Colleges. America's aging population, coupled with doctor retirements and a lack of available residency slots for those graduating medical school, are pressuring the system. Experts say team-based care, smarter technology deployment, and an increase in federal funding for residency programs would help to ease the shortage.
The challenge of having enough residency positions really comes down to having enough resources to support training at teaching hospitals across the country in communities big and small.
Liu is a first-year resident at the Abrazo Health Hospital System in Greater Phoenix, which recently added 2 new residency programs to attract physicians to train in the state.
Arizona currently has a shortage of about 600 primary care physicians, a number that will grow to nearly 2,000 over the next decade. So the hope is that doctors will stay in the state to help fill that gap once their training is complete.
It is our belief that by training them well, by providing a very good educational environment, as well as by teaching them for future endeavors in life, we will be able to retain them in this community to serve our growing population.
Perfect. Thank you.
Arizona is doing more than just adding residency slots to tackle the issue. Governor Doug Ducey recently signed a universal licensing recognition law to help those with out-of-state licenses gain similar licensing in Arizona.
We have more jobs available in Arizona today than we have people to fill them. We do think in terms of the doctor shortage, this is a tool in the toolbox.
Back at Abrazo, Liu says the best part of this phase of training is getting to help patients, including the older population that first inspired him.
The most rewarding part is talking to patients and just seeing them progress. Most of our patients, get better, and are able to leave here, better than when they came in.
For Nightly Business Report, I'm Kate Rogers in Mesa, Arizona.
A setback for PG&E, and that's where we begin tonight's market focus. Legislation that would have helped the utility pay off billions of dollars in wildfire liabilities was shelved. The California lawmaker who introduced that bill says it needs more debate and time for discussion. The measure's failure, though, complicates PG&E's restructuring plans. The shares dropped about 3.5% to 10.19. The Trump administration unveiled its plan to privatize Fannie Mae and Freddie Mac. The blueprint calls for ending government control, reducing risk to taxpayers, and introducing more competition. Fannie and Freddie guarantee about half of the $10 trillion home loan market. Fannie Mae and Freddie Mac both dropped more than 8%.
Alibaba is buying Chinese e-commerce business Kaola from the gaming company NetEase for about $2 billion. Kaola sells imported products in China that include clothing, consumer electronics, and luxury goods. Alibaba's stock slipped more than 1% today to 176.69. And Symantec has reportedly received a buyout offer from two private equity firms. According to the Wall Street Journal, the two firms would take control of Symantec's consumer security business while preserving Broadcom's previously announced acquisition of Symantec's enterprise security assets. The deal could be valued at about $16 billion. Symantec shares rose about 4.5% today to $24.52.
Which brings us to our weekly market monitor, who has a list of companies she says will benefit from the services sector investment in the cloud and network security. Joining us once again is Nancy Tangler, Chief Investment Officer of the Tangler Wealth Management Group. Welcome back, Nancy. Nice to see you again, as always.
You too, Sue. Thanks for having me. Hello, Bill.
Bill just talked about Broadcom. That's one of your picks. Why do you like it?
Well, for a couple of reasons. The CEO is consistently underestimated, but he's been transitioning the company from a pure chip play to a software and security play. And so you just said that they purchased a portion of Symantec's enterprise security solutions. They also purchased Computer Associates about a year ago, and that's where all of the growth for the second half is going to come from this year. They have a 3.6% yield, and they've been raising the dividend about 50% a year. So in terms of total return, this stock has returned about 30% a year for the last 5 years, but is still very cheap.
Second, Microsoft. When you think about the transformation of this company and what the cloud has meant to them, how much more growth is there for Microsoft from the cloud, do you think?
Well, the cloud's growing, very quickly, Bill, and they are growing at 60+% year over year. That's down from 90%, but now they've started to take share from Amazon's AWS. So I like that portion of the business. The margins are exceptional, and they pay a dividend about in line with the 10-year Treasury, and they've been growing at about 10.5% per year. So even though it's up dramatically, it's still attractive on our valuation, one of our largest holdings.
And next is Palo Alto Networks. No dividend paid here, but you're taking a 3 to 5 year time horizon on this stock, and you're very bullish on it.
This one, see, this one's a little bit more volatile because it's a smaller company. They're growing very quickly, about 22% per year, and they're transitioning from an enterprise solutions company to more of a cloud security company. So right now, think firewall. They're trying to transition the security to the cloud so that their clients can have one vendor instead of 9 or 10. So this is a company that's very well managed, still attractive on our valuation, and we think it's a great. Sometimes you need to take more risk than you think, even when stocks are modestly expensive.
On that note, Nancy, thanks so much.
Thank you, Sue.
Nancy Tangler with Tangler Wealth Management.
Now, you probably have heard the recent reports about hackers taking over the Twitter accounts of high-profile users, including Twitter CEO Jack Dorsey and various celebrities. Once they had access, they tweeted out expletives and other offensive messages. How did this happen? Well, as Andrea Day reports now, it's likely coming from someone tricking cell phone providers.
These attacks should serve as a wake-up call.
A message from IBM's Charles Henderson. He's talking about recent attacks targeting high-profile Twitter accounts, like Twitter CEO Jack Dorsey and actress Chloe Moretz.
I think if the industry does not move away from mobile phone numbers as a factor of authentication, you're going to see this abused more and more.
About a week ago, hackers took over Dorsey's account, using it to tweet out offensive messages. The hacking group Chuckling Squad claims to be behind it, and experts believe they used an old-school attack called SIM swapping.
It's really easy to pull off. You go into a cell phone store, you lie, you get a phone, you reset somebody's account. This doesn't require the world's best hacker.
Here's how it works. Henderson says the hacker tricks the mobile carrier into reassigning the victim's cell number to a new phone that they own. Hackers can then use the phone to publish tweets via text. Twitter has now turned off its tweet by text service in most locations. The company directing CNBC to this tweet in part. We're taking this step because of vulnerabilities that need to be addressed by mobile carriers and our reliance on having a linked phone number for two-factor authentication. Twitter responding to the attacks with this in part. The phone number associated with the account was compromised due to a security oversight by the mobile provider. According to Henderson, similar attacks can be used to target bank accounts, as many companies rely on text to authenticate users.
It's mostly high-profile individuals, executives, people that are seen to have big bank accounts. Because when you're doing this kind of very manual attack, you want to have a high return on investment as a criminal.
And he says one of the reasons why this all works is that people at the cell phone stores are there. They're wanting to help customers. They're wanting to help them buy a new device. So it's a fairly easy attack to pull off. For a Nightly Business Report, I'm Andrea Day.
Coming up, Renovation Nation. Making over a bathroom can be chaotic and costly, but one startup is on a mission to change all of that.
Finally tonight, the story of a company that does want to make home renovation a little less painful. Two New York City entrepreneurs got the bright idea to give both homeowners and builders incentives to use their one-stop shop for materials, designs, and construction. The thought of home renovation makes most of us wince. The order of the day is usually cautious pessimism.
The joke is that neither of us would renovate even if we could afford to.
We thought about renovation as an insane, in a poor way, experience for folks. Yeah, this is a new bathtub.
Trying to simplify the renovation process might sound even more insane, but Luke Sherwin and Koda Wong are trying. Their digital platform, Block, aims to improve confidence for both owners and builders when it comes to quality, cost, and convenience.
These are before and afters.
Focusing on bathrooms since launching in December of 2018, Block has completed almost 100 jobs in apartments and single-family homes in New York City and in New Jersey. They say Block's average cost is slightly below Remodeling Magazine's mid-range average, about $28,000 in the New York area for an existing 5x7 room. The national average, about $20,000.
We find a lot of people are sort of paralyzed by how many thousand combinations are out there. Yeah, it's a nice color.
By limiting its range of products, Block knows what it needs, and it can negotiate prices for tubs and faucets, vanities, and the like.
We create a 3D model.
It also streamlines the design process.
A completely custom design would take probably around like 5-6 hours versus doing it using the products in a catalog takes about an hour.
It basically is an efficiency on every single step of the renovation process.
Sherwin and Wong say efficiencies are gained in the construction phase too. Block vets and hires its own builders.
Their guys are showing up and everything is ready for them to install. And because Block acquires the customer, you're eliminating this dance that renovators have to do.
Instead of the dance, the dreaded bidding process, Block gets builders to accept lower fees by making their jobs easier.
They don't like to do marketing on Instagram.
They don't like to do all the little billing and administrative work. They don't like to be sending out 20 proposals and hoping to win one.
They do like to build, though. Sherwin and Wong believe dangling a carrot, a pipeline of future projects, eliminates a builder's greatest fear, finding the next job.
You don't have to go to the customer, you don't have to call them and say, what about this, what about that, sizes, specs, finishes. It's just so streamlined. So I could potentially set up a crew and do multiple jobs at once.
This soup to nuts bathroom reno in New York City took less than a month. That's a third of the national average, and it cost about $30,000, just above the New York average for a mid-range project, including some custom plumbing and detailing. Sherwin and Wong are already testing the block model on kitchen projects, and they're working to expand beyond the New York area.
If this works, and it works at scale, then both the homeowner and the contractor should benefit.
By the way, we should point out that neither Sherwin nor Wong has actually renovated anything themselves, although Sherwin's father renovated brownstones in Brooklyn for years. Both, however, have had a hand in prior digital success stories. Sherwin at the mattress company Casper, and Wong in fashion at Rent the Runway.
Before we go, here's another day's look at the numbers on Wall Street. The Dow managed to add 69 points to 26,797. The Nasdaq fell 13. The S&P 500 was up 2. All of the major averages were higher for the second straight week.
And it was only a 4-day week, too. We had pretty good gains
exactly,
there.
right? Well, it's a good way to go out into the weekend.
Off to a strong start for September.
That is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you Monday.